Thank you very much for joining us. We have Ches Hagen from AP Capital. That's Alta Pacific Capital, talking about a mortgage investment corporation tonight. Ches, welcome to the line.
Thanks, Peter. Good evening.
Yeah, we did this recording a year ago, and I think it's important that things have changed in the marketplace. So it was very important to look at doing this again. So a couple of quick housekeeping items. First and foremost, we always have to start with a disclaimer to remind people that this presentation is for educational and informational purposes only and is only intended solely for the registered participants of this event. And for that purpose, shall not be used. Otherwise, any information in it is for, again, from an educational perspective. Ches, you guys also have your own disclaimer. If there's anything you'd like to add to that, please do so.
I would just add, Peter, that for those that might contemplate making an investment into a company like ours, it's important that they read the complete offering memorandum, which is always provided to them, outlines all the details. Most of the information that we'll go over today is a lot of high-level description of the business and what we do every day, but the OM is key for folks to have a review of.
Perfect. And, on that note, the other housekeeping item I want to put in there is we do have a list of a section for questions. It's on the on your GoToWebinar. There's a bar there on your it should pop up on your screen. So if you just want to click on questions, and if you have any questions, just fill in, type it in the bar there, and that'll come to me directly. And hopefully the computer glitch here is resolved. But before we jump into what a mortgage investment corporation is and what a MIC is and private lending, I just want to touch on a couple of things. There's a couple of articles that came out from Thane Stenner in the Globe and Mail talking about what high net worth investors are investing in these days. And one of the things is a lot of high net worth investors are starting to add a little private equity into the mix because they're what's referred to as non-correlating. They're separate and independent from direct real estate investing, separate and independent from investing in the public stock markets. AP Capital is one of those examples of a private equity opportunity. Again, here's an example of the Tiger 21 group. Tiger 21 is a group of peer-to-peer investors that invest in real estate. They invest in a whole bunch of different things. So it was always interesting to see what are the wealthiest individuals in North America investing in these days. And we noticed that 30% of their investments were directly into real estate versus 21% in the public markets. And there it is, private equity again, 21%. So AP Capital, an example of private equity. So again, another, just further to that note, the Canadian Pension Plan separates and has non-correlating assets in private equity, public equity, and real estate. So obviously, Ches, a lot of big players are now looking to private equity to supplement their investments so that it has the ability to be non-correlating. Have you found that's the case with your experience, that a lot of people are looking to invest into private equity in addition to stocks and bonds?
For sure. We've been doing this now for 10 years, and I'd say, Peter, that over the last decade, we've just seen sort of a growing interest from, wealth management folks to just your average Canadian investor as they become more aware that, investing is not just equities and bonds. It's not just mutual funds and, ETFs, which is the popular kind of new mutual fund, if you will, over the last couple of years. But they're starting to learn more about, what some of the most sophisticated investors and fund managers have been doing, and that is investing in private equity.
Yeah. Now, you guys are an example of private equity. And basically, private equity just means that you're investing into something that's not trading on a stock exchange. So real quick, let's just jump to what investing in mortgages is, because obviously people out there have a mortgage and they understand that maybe if I got a mortgage from a bank, I'm paying 3%. And, one of the things we show here is that with investing in AP Capital, that you can get a 7% monthly cash distribution or 7% annualized, pays out monthly, et cetera. So let's just talk, what exactly is investing in mortgages and what you guys do with the MIC?
Yeah, good. A common first question. First of all, mortgages are essentially loans that are secured by real estate or properties in Canada. So the typical mortgage that we think about as Canadians is the mortgage from one of the larger banks or credit unions in the country. And when you go to buy a home or you're refinancing your existing home, typically you're looking at 25 years or 30-year amortization schedules, because paying off a $300,000 property or a $2 million property takes time. So that's your conventional mortgage market, and it's owned by the large banks and credit unions that exist across the country. But there's another segment of lending that goes on in Canada, and that is where people are utilizing their property as a form of equity in their life that they wish to gain access to. And so there's a niche market, if you will, where people need to use the home as collateral, where they accept a mortgage onto their property, receive funds in exchange for that mortgage. But in our world, we do so in a very short period of time. So we advance one-year term mortgages. So the trade-off is shorter term mortgages, but higher interest to borrow that money.
Yeah, when you look at that, there's different types of private lending. Now, you and I talked about this earlier today. We wanted to avoid the word private lending. So when you talk about private lending, you were saying that you guys don't consider yourself private lenders. Why is that?
Well, there is two real, common types of private lending. Private lending has existed, for decades, for probably as long as there's been money exchanged, and that is where one party, a person, might lend money to another. So in Canada, I can be a, quote, private lender by essentially offering my neighbor or a family member or a friend or a stranger funds in exchange for a mortgage on their property, and my name would then go on to title of their property. Another form of private lending in Canada is syndicated mortgages, where rather than just my name, it could be Peter Kinch and Chess Hagen listed on title, because we've privately lent funds to a party. Now, the reason, then when you look at banks, credit unions, and mortgage investment corporations like AP Capital, we are, fully operating businesses. We operate with certain guidelines around how we can actively exist and participate in the market. We're regulated by various entities from a regulatory standpoint. And so there's just different tiers of what we'll call conventional lenders and then alternative lenders, which would be a more appropriate way to label a mortgage investment corporation.
Yeah, so let's take a look at those, because it's very important to distinguish between those three levels. So first of all, obviously, you can go to a bank and get a mortgage. But if someone is lending and for whatever reason they need to borrow money from, let's say, a private entity, they can go to a mortgage investment corporation, they go to a syndicated, or to a mortgage direct individual. Now, what we're talking about tonight, by the way, is not just obviously not borrowing from a mortgage investment corporation, but investing into it. Now, if you're an investor, it's really critical, essential that you understand the difference between investing into something like, for example, a private mortgage to an individual versus investing into a syndicated mortgage versus investing into a MIC. And again, you'll hear us use the term MIC a lot, and MIC just means Mortgage Investment Corporation. So again, Chess, I think one of the things that's really important is to try to create the distinction on a risk parameter, in terms of a scale of risk. A lot of people, I'll talk to somebody and say, AP Capital targets, and we'll get back to what targets means versus actually what you guys are, how you perform. AP Capital targets a 7% return, and quite often I'll talk to somebody and say, well, I'm from Ontario, for example, and in Ontario we can get 10 or 11 or 12% return from investing into a syndicated mortgage. Or I know a friend of mine who is they have a piece of property, a rental property, and if I lend my money directly to that individual, then I might be able to get a 12% return as a second mortgage on their rental property. One of the things I always talk to clients about, I eventually always do a gap analysis with my clients. And when we do a gap analysis, the concept is to say, what returns do you really need? Interestingly enough, I find most of the time people don't need those double-digit returns to really accomplish their goals. But one of the things people forget is that the higher the return that you're potentially getting, there's a correlated risk associated. So I think it's really important that we touch on the risk versus reward component of those three categories. So let's just deal with personal lending. That's where one individual lends to another individual. And you can put a second mortgage on my property, and I might pay you 12%, and you can register that in your RSP. It could be a self-directed RSP. So, Chess, when you're lending from one individual to the other, true private lending, touch on what some of the risks might be.
Well, it's interesting. There are many, and there are many pitfalls that people should look to avoid. If you talk to a British Columbian, this term private lending, syndicated mortgages is not sort of front of tongue or like on the top of their mind. It certainly has been more prevalent in provinces like Ontario. But essentially, what you're asking a person to become in order to become a, quote, private lender is to become well-versed in the real estate space and the lending space, and therefore essentially putting on the hat of a mortgage underwriter. And most Canadians, that are not a mortgage underwriter, that's not what they do all day, every day. So here at AP, we have a team of underwriters. We look at, a dozen files a day. We discard probably 8 to 10 of them, and maybe advance commitments on 2 or 3, and then advance mortgages on 1 or 2 every single day. When you're a private person advancing funds to another private person, you maybe don't see that volume of activity, and therefore kind of sifting through the noise and a good deal from a bad deal is tough for a private individual, let alone then, papering the contract so that it's a secure mortgage, that they're listed on title, like just the whole mechanism of being a lender. There's a lot of moving parts. And I quite frankly think it's a lot to ask of an average Canadian or even a sophisticated Canadian to roll up their sleeves and be a mortgage underwriter once or twice or 4 times a year if they consider going down that road. And then there's the whole notion of what happens if that borrower doesn't make their payments on time, or what happens when the term comes up and they don't pay you out, and how do you deal with
totally.
it? Yeah. And I think that's the part where people really need to think about, okay, how do I manage this when maybe things go off the rails a little bit?
It reminds me of the old saying, like, it's always good until it's not. I was talking to a private lender in Toronto who lends money out, and he says one of the things is that his investors, for example, and sometimes you can go through a mortgage broker and get leads on people who need private mortgages, and you could be a private individual that lends to private citizens. And one person said, people think they get really good returns. For example, they might have 12% on a second mortgage, but that doesn't mean you're getting that 24/7, 12 months of the year, because that mortgage might be a 6-month mortgage, 8-month mortgage, or 9-month mortgage. And then when that comes up for renewal and the person gives you the money back, you might sit 1 or 2 months sitting on cash before you redeploy that money into the marketplace. So there's also the consistency of return as well. Plus, what happens for an individual, if I've lent my money to Billy Bob Joe, Chess, what happens when I have to foreclose? Can you walk me through what that process looks like?
Sure. I mean, as a mortgage lender, I think it mentions it on the slide on the screen, but we've done over 1,000 mortgages, which is not, in the grand scheme of big bank world, a great volume, but it's we've learned a lot doing 1,000 mortgages. And there's always mortgages in foreclosure. So it's just the nature of the lending business, whether you're RBC, TD, BMO, or AP. But if you're an individual and you advance your, $20,000 RSP or your $200,000 RSP or your savings account into a specific mortgage and it goes sideways on you, the path to foreclosure is one where you need to have good discipline and rigor. In our space, we work with the best mortgage enforcement lawyers in the market. And you also have to be patient. You have to be willing to kind of understand that, if you're an individual, it can be very stressful. You've maybe been receiving these monthly payments, and then all of a sudden they stop coming in. You have to, the foreclosure process, I won't get into the details of it, but it's rarely less than 3 months. It's typically more like 6 to 12 months. And so in that 6 to 12 month period, the person, if it's their own money in one deal, has a level of anxiety, is not receiving monthly payments, is oftentimes just, it can be very, very stressful for them. If they lent well going into the deal and there's plenty of equity, they'll probably be fine. But it's just sort of like, if you've talked to anyone that's been a quote private lender and gone through that, sometimes it takes away their edge on their desire to do it again. Whereas for us, This is what we do every day. And, 1 to 2% of the portfolio might be in foreclosure at any given time, but we follow our process. We have a great track record on collecting, even on those defaulted loans. And it's just the course of business for us.
Well, and that's so true. I mean, because at the end of the day, there's a big difference between you lending to an individual and kind of hoping that all works versus having people who know what they're doing. Just a quick housekeeping item here, Chess. I'm going to try changing presenters here because apparently we're still having challenges. So I'm going to flip flip it over to you, and let's just see if that gets rid of the problems with the. I have people tell me that the screen's still flashing here, so let's.
Well, I'm gonna take control of the screen, but it was flashing to a combination of kayaks on the beach. So I wondered if you were maybe doing that on purpose to.
No, that's my homepage. So
okay, well, I'm gonna.
Let's see here, and again, apologize for this, folks. We just had some. I'm not sure what the reason for that was. Sometimes
so I'm sharing my screen now, Peter. Is it showing on your side? It should be.
I see it on my side.
Mode.
And
okay.
Let's hope that fixes the problem there, that whatever we had on our side. So there you go. Again, that's very distracting. So apologies to everybody out there who had to put up with that. But so let's go back to what we're talking about is the difference between lending directly to somebody and versus syndicated mortgages versus a mortgage investment corporation. Really important to understand these distinctions because at the end of the day, if you're lending your money out in mortgages, you have a certain return you're trying to accomplish. That's great. But the bigger than that, you have to measure out the risk that you're willing to take for that return. And it's critical that everybody understands that risk-return correlation, and I find that something not everybody understands. So now let's talk about syndicated mortgages. We don't see this a lot in British Columbia, but I know back in Ontario, huge. Almost everybody I talk to there says, well, I'm familiar with a syndicated mortgage, never heard of a MIC before. In BC, it's the opposite. So let's take a look at what a syndicated mortgage is. Maybe, Jess, you can touch on that for a bit.
Sure. So oftentimes syndicated mortgages are originated by a mortgage broker, and then a mortgage broker will look to find two or more people to pool their funds together on a single mortgage. So let's say Peter, you and I and my brother Todd. So the three of us would go together on a mortgage, and maybe we'd put in $100,000 each, and we'd all advance $300,000 to a particular borrower. Now, oftentimes, not always, but oftentimes they're on construction type projects, they're on developments, they're on commercial financing type arrangements. So they tend to be in a type of lending where somebody needs to be quite savvy in that underwriting process. And again, if mortgage underwriting isn't what you wake up and do every day, you can miss some very important, which most people don't, right? And so there's some really important moving parts to underwriting the deal. And, whether that's looking at the appraisal in a very educated manner, looking at the borrower's profile in a very, very educated manner. And so really not much different than that one-to-one example that we talked about earlier, except that you, me, and one or many others can all participate in on a same deal and see really what it is. I think for a lot of people is some people like to see their name on title, whereas when you invest in so we can get into that, but that gives you.
I want to touch on that because you know what, I was talking to one guy who's very sophisticated. He understands mortgages really well. He's sitting on a ton of cash, and when he lends his money on a mortgage, he wants to be able to go out there, touch, feel, and know exactly what he's lending on. So someone like that has a degree of sophistication. He or she will be targeting, maybe north of 10%, but they know what they're doing. They're very familiar with the risks associated with that. And if they had to go into a foreclosure process, they're comfortable to do that. I think what's interesting when you mentioned on the syndicated mortgage is, by the way, what it means by syndicated is that you could have 3 people put up $100,000 each, and then that's lent. And if I'm not mistaken, Chess, then each person's actually registered on the title, correct?
Correct. Yep. Correct.
Now, let's touch base on it because you mentioned something that quite often they'll lend to a developer. And this is really, really important in my books. If you lend to a developer, let's say someone's building a commercial building, they're building an office tower, and they got a first mortgage at a bank, but now they need to borrow a second mortgage, and they go to they're looking for a syndicated mortgage. So a mortgage broker comes to you and says, I've got this project, and if you put your money and pool it with these 3 people or 10 people, however many, we're going to put a second mortgage on that property, and that developer is going to pay out 10%. Okay, so it sounds like a great investment. Now, Jess, what happens when the developer, let's just take a step back and say, let's make a list. Maybe you and I could do this, have fun. Let's make a list of what could possibly go wrong there. So we got one developer building a commercial building. Give me an idea of some of the things that could go wrong that could cause that developer to either stop making payments or have to go into foreclosure.
Well, if you've ever been a part of a home renovation or built a home with your spouse or been a part of a development, the chances of everything going on time, on budget is generally pretty low, right? Whether you're renovating your kitchen or whether you're a part of a large commercial development, time and money are the 2 things that often you have a good solid plan and then something doesn't quite work out. So what often happens in development type deals is that, a person needs the money longer than they expected. They run into challenges on the timeline. The market can shift, right? Demand looks strong. Everything's going to be great. We're developing this subdivision or this commercial property. We're going to have all of our expectations and forecasts are going to fall in line in these nice little compartmentalized timelines. But when things kind of come off the rails or are delayed, those are the things that can start to then back up onto the lenders on, the challenge of making payments if you weren't quite achieving timelines in time. So
yeah, and that's on a scale of 1 to 10, the probability of something going sideways. What would you say on a typical development?
Well, I don't know about when I think going sideways, I think like somebody just flat out not being able to make their payments and perhaps the deal's underwater, and I think that's going a bit far. But it can kind of go to that status where I mentioned before, where the person maybe isn't in a position to continue making payments. It's stressful on the lender. The other thing that often happens is that when people are not super sophisticated in the lending side, they might look at appraisals based on future value, not as is current value. If you take a development property, either a commercial building or a development property or a home under construction, any one of those has 2 different values. It has the as is current value, maybe before the windows go in or before the roof goes on or before it's has occupancy permits in place, versus it's done and ready and has a family living in it or has tenants occupying the premise. Those are very different values. And oftentimes people are being presented opportunities based on future value, which is when it's completed. And if you're lending to a value of when it's completed and it's in development or under construction, that current as is a much different number that presents a whole different set of risk and circumstances that people must consider, because sometimes things can happen and then you're left as a lender. If you're lending against construction or developments, and I kind of stop for a moment and say, we don't do that at AP Capital.
Yeah.
I'm sure we'll touch on that.
We'll circle back to that for sure.
Yeah. So those are just things to be mindful of as individuals, whether you're in a private situation 1-to-1 or whether you're in a syndicated mortgage, is really, what are you lending against, and are you really, really aware of all the things that could steer that, what looked like a great scenario down a slightly altered path?
Yeah, because you know what? If the individual you're lending to, if it's private one-to-one, if that individual keeps making their payments every month and things go off without a hitch, it's fantastic. I got a 12% return in my RSP. And by the way, you can register all these into an RSP vehicle. Most of them, not all syndicated mortgages. By the way, I don't think syndicated mortgages are allowed in a registered fund, but we'll touch on that later. The other thing that I know, I used to run my own MIC, Mortgage Investment Corporation, a number of years ago, and one of the things, the rules of thumb from lending, as a lender, you always think, and I'm sure you guys do the same, you always think like, if I'm going to lend on that property, I have to assume the person I'm borrowing the money is going to default. And the reason I want to do that is because then I'm going to ask myself, what asset do I own at the end of the day? So, because if you think about this, folks, if you lend your money out and you expect it to be paid back, but obviously if something were to happen and the person who borrowed the money, for whatever reason, can no longer return that capital to you and make the monthly payments, you have to foreclose. So the key here is how fast can you foreclose? How fast can you get that property sold and get the money back into your bank account so you're not losing money? And hopefully you can have some interest accrue. So Chess, we're going to talk about what you guys do at AP Capital for a second, but let's just touch on the fact of if you were in a syndicated mortgage, and let's say it was, I'm going to give you three scenarios. It was farmland, it was a commercial property, or a development. What happens when you foreclose, and how difficult or easy is it for the syndicated mortgage fund to either take over the project or sell it, liquidate the asset, and get the money back into the investor's hands?
Well, A, I've never been a part of a syndicated mortgage, so I don't have experience on that front. And B, as AP Capital, we don't lend against those three types of product types. But to answer it quickly, if it was the home property of the farmer, there is severe challenges in foreclosing against the quarter section of land that person lives in and provides for his family. Very different than other parts of the real estate market. And if it's the other one was a development under
a development and or a commercial property, either
right, and those
residential
ones,
or commercial.
I mean, you're just in a space where you might have to like step in and roll up your sleeves and finish the development. I mean, these are things that most people just don't want to have any part of. So again, I have to go back and say I haven't been a part of syndicated mortgages myself, and at AP we don't touch those lending types. We don't go into those worlds because of the challenges that you can face. Now, as you mentioned earlier, you can do well. They often have rates and the package on the lending looks very attractive, but when things don't quite work out,
it's always good until it's not.
That's right. That's a good saying. I'm going to remember that.
So let's go. Okay, we've talked enough about what direct one-to-one lending is, what syndicated mortgages is. Now let's talk what a mortgage investment corporation is. And by the way, folks, what I'm trying to do is help you understand the difference between the different levels or different types of mortgage lending that exists out there. Because if you're considering investing in mortgages, it's critical that you understand the differences between us. Because if you're doing your research, you're going to learn about the ability to have, an RSP second, direct lending from one individual to the other, or maybe a syndicated mortgage. And then you're going to hear about MICs, and we're going to talk about not all MICs are created equal either. But before we go there, what is a MIC, and walk us through an example of what you guys do?
Sure. So just really quickly, MICs were legislated by the federal government in Canada in 1973. And so they've been in existence since 1973 in this country. And there is a, quote, MIC in, I would say, every province. They've been very popular in the western provinces. They have been a little less popular in Ontario, and a lot because of the popularity of syndicated mortgages. So the Mortgage Investment Corporation has been around for a long time. Today, it's estimated that the MIC space is about $10 billion. To put that into context, there's about $1.4 trillion in mortgage debt, and I always have to kind of do the math on what's $1 trillion. Well, that's 1,400 billion. So the MIC space is 10 billion of 1,400 billion. So we are small players, if you will, in the grand scheme of the mortgage space for residential mortgages. But 10 billion is still a reasonable amount of capital in this space called Mortgage Investment Corporation.
Well, yeah, so, from an investor perspective, it's a massive space.
It is. It is.
In the world of mortgages in Canada, it's a relatively small one.
Right. So, what is a MIC? A MIC is essentially a financial institution where investors place their capital into a pool. They receive shares in exchange for their funds invested into the corporation. So they become shareholders of the Mortgage Investment Corporation. And then that corporation becomes the lender with an underwriting team, and in our case, a team of 3 or 4 that every day are looking at files, looking at deals, and making good decisions because they're able to sift through, like I mentioned earlier, 8 to 10 a day to discard, 6, 7, saying not interested, and then seeing a couple that they like based on our parameters of what we lend against. And at AP, we lend against single detached homes, primarily single detached homes in urban markets. And why do we like those? Well, urban markets, there's lots of comparables. So if we see a home in, Vancouver, BC, or Langley, British Columbia, or Calgary, Alberta, we know that there are comparable homes in the near area that we can compare values against, right? If I look at a property
as opposed to a development.
Yeah, as opposed to a development where you're like, well, if everything works out and the zoning gets done on time and the building lots go out at this, well, then the whole package is going to have this huge lift. That's just not the world that we participate in. We like to look at a house and say, okay, the appraised value by an independent appraiser is X dollars. We're going to lend up to maximum 75. Our book of business today, and I'll touch on this in a future slide, is about 60% loan to value. So there's a buffer in the event that house prices do drop. But maybe we can just kind of advance through some of the slides here to cover this.
Yeah, because I really want to touch on the concept of a pool that you're investing into a company, getting shares in a pool versus being on title and lending directly to an individual.
Right. And so the day that somebody becomes an investor into AP Capital MIC, they are immediately a part of 256 mortgages. Okay, so we've done over 1,000, but in the current pool, there's 256 mortgages. So the moment somebody becomes an investor, they're a part of those 256. So if 1, 2, 4 start to go sideways on us,
I think you got a slide on that, right?
Yeah, I think if I just, I'm going to find out
here
which slide it is. 3?
Yeah.
Okay.
4,
here.
3 slides.
So this is the current portfolio. We have about $70 million in mortgages. It's 256. So this is what a new investor becomes a part of, essentially, the day they become a shareholder. And so they have that diversification across, 250. And they can see that, okay, the loan to value of the fund is 60%. That means that there's almost 40% equity in those 256 homes that protects the capital of the corporation, which is their capital, and 1,100 other shareholders. We publish these fast facts plus another 18 or 19 every single month. They land in the inbox of every investor every single month, so they can keep track of what the pool of funds is doing and monitor the use of, where their funds are at work.
Okay, so the biggest difference between this and a syndicated mortgage is that when I give you my money, let's say I take $50,000 in a TFSA or RSP and I throw it into AP Capital, I'm going to be one of 1,000 investors, and that pool of capital, which is currently sitting around $70 million, is then lent out over 256 mortgages, right? Now, when we were talking about one individual lending to one individual, there's potential risks of what could possibly happen for that borrower to go into default. Well, those risks still exist with you guys, correct?
For sure. I mean, there's always risks in all investments, and in our space, it's the risk of a couple elements. One, the risk is as we raise capital, perhaps we don't find good quality deals that we can lend to. And so there has been situations in our past where we had to sit on cash because we're not going to do deals just for the sake of doing deals. we're only going to lend money in mortgages when we see ones that we think make a lot of sense. And so the one risk is that we sit on cash. That doesn't mean people's principal is at risk, but it does put our returns at risk.
The other element, make the return less.
You're right. So there's, it puts pressure on returns. Another is that, people lose their jobs. They can't make their payments. We foreclose. When we foreclose, the house prices dropped off dramatically. And that happens to us. People lose their jobs, stop making payments, we foreclose. But we have, as you see on the screen here, on average, close to 40% equity in each of these mortgages that we advance. So we don't, out of 1,000 mortgages, we've lost a little bit of principal on 2 deals. And 99 times out of 100, we get all of our principal back plus return because we lent wisely at the beginning. So when things went sideways for that individual and we had to come in and foreclose, we were able to get all of our funds back. So, there would have to be a series of economic calamities, I suppose you might say, where house prices were dropping at rapid rates month over month. And in that case, you'd have people that potentially can't make their monthly payments, and we're in a position where homes are upside down. But we'd have to see houses cut by 30% in a short period of time.
Well, emphasis on short period of time, and I'm going to circle back to that. But before I do, I want to also really highlight something that's on the screen here, and I think it's critical that you guys highlight this. I just happen to know this because I get the monthly fast fact sheets. You're, as a company, and quite likely as an industry, MICs are probably comfortable in the residential space with up to 2% of the portfolio being in foreclosure at any point. Would that be an accurate statement?
Yeah, I think 2% is even on the low side. It could be anywhere between, I always say kind of between 1% and 5% of the portfolio in foreclosure is not a statistic that people should be alarmed by.
What is the current statistic? What percentage of the portfolio is currently in default or in foreclosure at this particular point?
Sure. At September 30th, it was just short of 2%.
Okay, perfect. Now, what's important is you can't control someone's personal situations of when they go in default. And I guess one of the things I'm trying to emphasize here, folks, is that when you chase a high yield by doing a personal loan to one individual, and you're excited because you're getting that high loan, there's a bit of a rolling of the dice because anything can happen to cause any individual to go into default, and then now you're in a foreclosure process. If you're lending personal money to an individual, you're the one that has to go through all that foreclosure process. Now, in this case, you're part of a pool. Now, there's more safety in the pool because if 2% of the portfolio were to go into default, Chess, you guys are going to have a complete system to find a way to liquidate that asset, sell it through the court system. Even if it took 8 months to 12 months, the money will eventually flows through back into the fund, correct?
Yeah, 100%.
Right. Now let's touch on how does the investor make money in this? Like, how does that actually walk me through an example of the flow of capital?
Sure. So like I mentioned, in 1973, mortgage investment corporations were created by the federal government, and what they essentially are is they're required to flow through all net income to the shareholders. So as a operating MIC entity, we have the Mortgage Investment Corporation where all the shareholders reside. That's the pool of funds. And then we have a management company where essentially all of our staff and overheads are covered. When I mentioned the team of underwriters, they're in the management company. So there's a management contract between the manager and the MIC to run the business, and all remaining net income is distributed to the shareholders. So we take a 2.85% management fee to run the portfolio of mortgages, sourcing, managing them daily, foreclosing, dealing with shareholders, just the operating of a full, lending business. And then all remaining returns, net income is returned out to the shareholders. So
when you say that you guys are targeting a 7% return to the investors, then do I subtract that 2.9% fee that you guys are taking off that? So really, I'm getting closer to 4% return?
No, that 7% target, which we've achieved since we started over 10 years ago, is net of fees. So we need to be, we always talk about needing to wake up in the morning to generate a minimum of 10% so that we can management fee and then return our 7% target. So, maybe I'm getting ahead of your next question, but a common next question is, how can you get 10% when mortgages at the bank are 3%? Was that what you were thinking, Peter?
Pretty well, sure. Let's go there.
Sure. And it kind of goes back to what I said at the very beginning, that the bigger banks and credit unions are, amortizing 30-year term mortgages where we're in for 1 year. And so we definitely are on the higher interest rate front, but we deal with people that are in a different situation than buying a property and paying it off over 25-30 years. Oftentimes we're dealing with Canadians that are business for self. They're good credit people. They're often high net worth, but I often say they have a strong balance sheet, but they have an income statement that the bank doesn't like. So they're good credit clients. They're often in a business, that where they have corporate income, but they maybe don't show a great deal on the personal NOA that they file with RevCan. So when they talk to the bank, and even 5-6 years ago, they probably were able to get different types of bank offerings and different bank products and bank financing. And sometimes today they're finding that even at challenging at an increasing rate. So if they want to buy out their business partner or help their kids with a down payment or pay out a spouse if they're going through a divorce or execute on buying a new truck or excavator for their business or whatever the case might be, sometimes those people look to sometimes their largest asset, which is their residential home or properties that they own. And sometimes they're clear title properties. We do an awful lot of first mortgages, as you see on the screen, where they say, I want to get access to that property. I only have the intentions of using the funds for 6, 9, 12 months. And then I have, an exit strategy to pay it back. So that's a really common sort of scenario that Canadians find themselves in, especially these folks that are business for self or folks that have, a high net worth but don't show a lot of personal income.
And one of the keys here, because one of the biggest questions we get is like, who on earth is ever going to be borrowing? If an investor, typical investor for me, would probably have never gone to the alternative lending route. They might have had, always paid a bank mortgage, and they'll go, well, wait a second, who on earth would ever have to borrow at 7, 8, 9, 10%? And the answer is, you'd be surprised. So one of the things I was going to ask you, could you give me an example of a deal you've done lately? Because a lot of people might think that, this private lending or alternative lending, as you like to emphasize, is really, are we greasing the skids for somebody to go bankrupt by charging them an exorbitant amount of money and just really taking advantage of these poor souls? Can you give me an example where you guys have actually provided a Band-Aid solution or actually helped someone provide a bridge to get from point A to B?
For sure. And before I do, you mentioned exorbitant rates. I just have to remind us all that, we've just come out of, 7 years of ultra low interest rates. When we started back in 2007, conventional mortgage rates were 7.5%, 8%, right? Because prime was 4 and, or the overnight rate was 4 and prime was 6. And so we've kind of lived in this false sense of low interest rates, whereas Canadians with their conventional mortgage were kind of used to those high single digits. And so we're doing deals anywhere from 8 to 11%. We're not, I just would say we're not quite exorbitant. We are maybe when compared to, but in comparison to what people have been dealing with, a decade ago, it's not really outlandish. But to give you an example, if you're in a fixed term mortgage, as you know, Peter, and you're, let's say, 14 months from renewal, there's an interest rate penalty to break that fixed rate mortgage. And a deal that comes to mind is a family, a couple. They're wealthy. They had room to with equity in their home, but to break their fixed rate mortgage would have a higher interest penalty than to take a 8.5% deal from us with a 1-point fee, or I think it was a 2-point fee split with the broker. That was cheaper than the interest rate penalty if they were to break their fixed mortgage. So what are they going to do at the end of 12 months? They're going to renew their fixed rate mortgage. At that point, no interest penalty. We will be replaced with conventional financing, and on we go. What are they going to do with the funds? They're helping their children with a down payment. So there's just, I mean, that's just one example. We've done 1,000. You know, I kind of listed them off pretty quickly earlier, but
yeah, and you know, just for the sake of time, Chess, I don't want to drag that on too much, but I think it's a good, what a great example, because you're really helping people get bridge from A to B. And there's just, I think the big thing that everybody needs to understand is this is a $10 billion industry because there's a need out there. And one of the things that we have to really always remind ourselves is not everybody fits in the sandbox of how the banks lend, which is a great segue into the next question, because we're about to face new mortgage rules, and with the new mortgage rule environment that we're facing here, can you touch on how these new mortgage rules that OSFI, which is the Office of Superintendent of Financial Institutions, is about to roll out to us, and Ottawa is going to implement these as of January 1st, and it's not the first time they've done this. I think it's how you were saying earlier, how many times has OSFI actually implemented some changes to the rules?
Yeah, so since 2008, OSFI, who seems to be in the paper a lot lately, but this is their 8th policy change that impacts the Schedule A banks and the large trust companies. This is their 8th in essentially the last 9 years. Now, this one's been getting lots of press because it seems like it might be the most significant, perhaps the most significant of the 8 that they've done. I think this will be the 9th, actually. But each time since 2008 that they've been changing the sort of way in which the federally regulated lenders are to underwrite, it's increased the opportunity for alternative lenders like us. And so we've been seeing, you know, like we often say here, you know, inside the office, we say we're doing deals that the banks used to do just 5-6 years ago. Like we sometimes look at files and say, this was a bank deal just 5-6 years ago. And it's now a situation where, you know, we're doing purchase financing for people that probably would have gotten it from one of the big 5 just 5-6 years ago. So, you know, in some ways, the OSFI regulations have been very beneficial to alternative lenders like us because they've just given us more opportunity. There's just a growing amount of demand for this type of lending, and business has been strong.
Well, yeah, and it's a fantastic point, because I know you and I were talking offline that you guys are looking to really grow, really expand and attract more capital, more investors like the people listening to this call. So one of the things a lot of people may or may not understand fully, but the more often that the charter banks in Ottawa, the more strict they make the lending guidelines, that does 2 things for you guys. Number one, it increases the amount of people who now have to go to and deal with an alternative lender. And as you mentioned, you're dealing with people today who last year could walk down to Royal Bank and get a mortgage easily. So what that does is increases the number of mortgages you can lend on, but also increases the quality of the mortgages you're lending on.
No question. You know, I think it was about a year ago that I looked at the last 50 deals that we had done, and we looked at the credit scores of the borrowers, and they were all north of, well, I think the average came in at 670. And as an underwriter, you know, whether you're in a big bank, a trust company, a credit union, you know, the typical sort of feeling is you see 650 or better, and you kind of know that deal's going to, well, there has to be other elements, but, you know, the borrower's got a pretty good track record if there's a complete credit, you know, if that credit rating has a completeness to it. So, you know, we're not lending to people that have, sure, there's times where people have bruised credit and the story makes sense and we like the property and we'll lend to somebody with, you know, less than perfect credit. But we do see an awful lot of top quality borrowers in this, you know, especially over the last 24 to 36 months.
Yeah. Now, one of the things that a lot of people won't necessarily appreciate on the back end, not all MICs are created equal. We've touched on this. First of all, we talked about the fact that lending one-to-one is significantly, there's lots of challenges in that. Syndicated mortgages are great until they're not, and when they go into foreclosure, that's you have a high risk of losing your money. In a MIC, I think one of the things, I'm just going to touch on this because I don't want to go too much longer on this, but we talked about not all MICs are created equal, because some MICs will lend out on farmland, some MICs will lend on development or commercial. Can you just touch on it if we haven't already made it clear? Why do you avoid those, and why do you focus? One of the questions was, why does AP Capital choose to hold 95% of the mortgages in Greater Vancouver rather than spreading it out all over other provinces?
Yeah, I mean, all MICs are, created differently, and I think that the management teams have a niche that they pursue, that they understand. I think what you'll find is that most, have a history in a particular sector. So I know MICs that are not afraid to do construction lending. I know MICs that are in rural communities. There's MICs in different provinces that feel comfortable in their provinces. The reason why we're active in the Greater Vancouver, Fraser Valley market is that we live and work here and have been here for 40 plus years. So we know certain elements and areas and neighborhoods that we avoid and other neighborhoods that we like and gravitate towards. We also have a good relationship with many of the mortgage brokers that are the source of mortgages to us. So, it's, but the other thing I would add is that just 3 years ago, 40% of our portfolio was in Alberta. And then when we saw the change in oil, we saw a change in government, we started to, kind of cool to the Alberta market. And it kind of speaks to how quickly we can adjust the portfolio. We went from 40% down to less than 5% in less than 24 months. And that's because we didn't renew mortgages and we stopped doing, initiating and originating deals in the province and went from 40% down to 5% in less than 2 years. So because we're a short-term lender, as we see changes happening in the market, we can start to adjust where we do our next deal. So today we're starting to look a little bit more at the Calgary and Edmonton markets. We've seen some great deals there. And we're seeing house prices in the median income, median neighborhood range that really didn't see much of a price drop. The high-end stuff definitely saw a dramatic price impact. But the average family home and sort of the regular neighborhood of Calgary and Edmonton, we feel really good about today. So, I think every MIC manager has their sweet spot, has their niche, has what they feel comfortable with. I would encourage people when they look at a MIC to ask lots of questions about the current portfolio and what they do, and most importantly, what do they not lend against? Because I probably spend more time talking to potential, investors and people like you, Peter, about the types of deals that we don't do, because I think it really speaks to the way that our underwriters think and how we look at approaching deals.
Chess, you touch on something there because, as everybody knows, I'm a mortgage broker. So I have a joke that I always, something I always say that I joke about is, as a mortgage broker, I don't like you guys because you're too strict. But as an investor, that's what I want. So it's funny. It's very difficult for the average consumer, the average investor, to take a step back and do homework to figure out what's a good MIC, what's a bad MIC. Well, one of the things that makes a MIC really good is the quality of the underwriting, because at the end of the day, you have an underwriter inside and headed by Brad Unruh, who I personally know and is a good friend of ours. But Brad's he's incredibly skilled at looking at a deal and determining the risk, because he knows he's got, and something we didn't talk about, but you guys all have your own personal money into this, don't you?
Yeah, an awful lot of just our personal money, our family, and our friends, right? And so I said something to somebody the other day. I said, I don't invest in anything but AP Capital. And they said, well, as you outlined at the beginning, diversification and being in all these other things is so key. And I'm not suggesting anyone else should be 100% in AP Capital, but that's what I am. And because I come to work every day and I know what we're doing, right? And so, but we have a lot riding on what we do because we're personally invested in our families and our friends are. So that again, a very important question to ask a MIC when considering one is, not just what kind of deals do you do, tell me deeply about the current portfolio and what you don't do, but also like how much of you and your family and friends are invested in this, because I think it's really important.
Yeah, and again, we touched upon Brad and the quality of the underwriting, and Brad's one of those guys who understands the market very well. And there's been a few times I've phoned them up and I say, hey, I have this client needs to borrow private money, and this is actually it looks okay. What do you think? And he's like, yeah, it just doesn't fit our box. So again, as a mortgage broker, I'm not thrilled about that, but as an investor, I love it. The other thing that's really important is you touched on the fact that you do not accept more deals from just every mortgage broker out there. You're very selective. And what's important for everybody on the call to understand is that some mortgage brokers out there, will throw mud against the proverbial wall. And I know when I ran my MIC, the number one thing I wanted to, if somebody sent me a deal to look at, the first thing I looked at was not the deal, but the person sending it. Because there's some people, it's like if it's coming from that individual, there's probably something they're not telling me here, So I know Brad's very picky on selecting mortgage brokers that send them the deals. The other thing that a lot of people may not understand or appreciate is that if I send a private lend client to AP Capital as a mortgage broker, I want that client back in a year. So I'm going to work with that client to repair their credit or help them get back on their feet, try to figure out why. And it's purely selfish, by the way, because then if I can get that client to be bankable and get them over to Scotiabank or CIBC or TD, wherever, then guess what? I'm going to make another commission. So it's self-serving, but again, when you understand the mechanics there, having good mortgage brokers who are referring deals, then trying to get them out within a year, that's all good for you as an investor. It's an exit strategy on how these mortgages get moved in and then off the books.
Agreed.
Yeah, so interesting stuff here. Chess, the other thing, just touching on this, I know one of your quotes is like, this is what we do and why we do it. Do you want to just elaborate on that?
Well, I guess some of it has to do with just the story of how it started, but I mean, this is what we do. My partners have been in real estate since we literally graduated high school, and I maximized my RSPs when I was in an employment position and tried to self-direct them and got frustrated, but always, I shouldn't say always, but made money on real estate. So I wanted to find a new home for it and called my friend Brad, who you mentioned earlier.
Yeah.
He said he'd been dealing with MICs as a mortgage broker, and he said, you know what, let's start one. So, that was 11 years ago now, and I can tell you that the early days are, you're trying to find yourself, and but I'd say over the last 5 years, we've really started to really discover that we know this particular place in the world that we live in, single detached urban areas, primarily the western provinces. Over time, we might start to move across the country, but only as we start to gain understanding in markets and neighborhoods and communities that we feel really comfortable with.
And only if you have feet in the street that can analyze those properties, right?
That's right. We love what we do. We come to work every day and we have a good time, but we know at the end of the day, it's for our, for us, our families, and for all the shareholders that have come to depend on us. So that's why we keep going and love it.
Now, this all sounds rosy. It's wonderful. It's like, wow, my God, this is awesome. I can put my money here, and it's a guaranteed 7%. No, it's not. There's risks to any investment. So one of the things I asked you this question before offline, and I that was good. I think the Securities Commission would love it if I asked you this question. Obviously, that 7% is not guaranteed. It's a target. You're targeting that. Just real quick, historically, you've never returned less than that. Is that correct?
That's correct. I got a slide here that I'm going to jump back to. Jump forward to this one here. This just shows since 2008 the audited returns. In some of those early days, interest rates were higher. We did deals that were a little bit, I'll say, more creative. We were doing some double-digit returns in 08, 09, 2010, and then we started to really find ourselves into the world that we now live in, called single detached homes, and have hovered in that 7 to 8% range. Interest rates are rising. We saw the Bank of Canada raise the interest rates twice this summer. They're going to make another announcement tomorrow. Who knows what they do? But as interest rates rise, naturally that pushes up the price in our world. We don't price our mortgages based on prime, but there's just this natural sort of evolution of rates in our space that kind of follow what happens in the conventional rates. So the target is what we aim for. Half of our investors.
And if you exceed that, if you exceed the target, do they get a bonus at the end of the year? Is that how it works?
They do. So as I mentioned, we pay out all retained earnings. So as we exceed 7%, then there's a 13th distribution that comes to the holders.
And so here's the magical question: what would have to happen in order for you? One of the slides you had earlier says you've never lost any clients' money. What would have to happen in order for, in your opinion, AP Capital to lose money for an investor?
I mean, I think to just put it simply, Peter, there'd literally have to be just a catastrophic impact on the housing market in Canada. And when I say catastrophic, I mean that my house in Vancouver would have to be chopped in value by 50% in 18 months. And so, what I often say to people is that, if you have a true belief in real estate, if you have a good experience with it, you feel comfortable with it, yes, we're going to see a softening of prices. We expect to see one due to, everything from our provincial government policies to OSFI rules to just the Canadian economy. We think that, and we're planning for a 10 to 20% reduction in values over the next 2 to 3 years. Maybe it won't happen. Hopefully it doesn't happen. But there would have to get back to your question, there would have to be something significant that would hit the economy of Canada.
The economy in the market. And you could argue if that were the case, we have bigger problems and there's other issues at stake and other investments would be suffering as well.
Where would we put our money if that was the case?
But there's one other point. Sorry to speak over you there, but there's another point I want to interject here because there's a subtle component to your business model that is often missed, is that you mentioned there'd have to be a colossal collapse of the marketplace over 18 months. But here's something that's important for everybody to understand is that you guys have all your mortgages are either 6 months or 1 year terms. So over the course of an 18-month period, the entire book of business turns over. So arguably, 18 months from now, even if market was collapsed by 50%, a large percentage of your mortgages would have been relent at new values anyway. So that doesn't mean that 50% of the portfolio has been lost.
That's correct. Because the deals we're doing this month are based on appraisals performed this month. So if as the values are declining, we're now looking at new, lower appraised values. That goes into effect going the opposite direction too. So we have to be very conscious of that. And that's why, over the last 24 months, as we saw housing pricing really kind of rocket up in the lower mainland and Fraser Valley, we started to lower our threshold of what was our maximum loan to value. We used to do 85% loan to value on a great credit client. Now we don't go above 75 on a great credit client. So we're not mortgage insured. When you think about the big banks, you hear about CMHC and Genworth, those are high ratio insured mortgages backed by the government or Genworth. Whereas our insurance is that equity of, in our case today, 39%. That's our insurance, is the equity remaining. It's not the government of Canada called CMHC, and it's not Genworth. So we have to be a very different, prudent lender. We don't just have a backstop called a big insurance company or the taxpayer.
Yeah, and so again, in my book, I'm biased because I live in the mortgage world, but I believe wholeheartedly that you guys that a mortgage investment corporation and an investment like this is one of the lower risk. Certainly in the world of private equity, is probably the single lowest risk, in my opinion. I have to clarify that, but it's often not offered through financial planners and that. So one of the questions that someone's asked me: how does someone go about investing into APMIC through using their RSPs? I'll just answer that for you, Jessa. Quite frankly, you just give me a call, send me an email if you're interested in investing in this. One of the things that I have to do as a registered exempt market dealing representative, it's important for me to make sure and ensure that an investment of this nature is suitable for you. I have to go through a KYC, know your client process. And one of the things you have to do is if you're registering using your RSPs or your TFSA, and by the way, I think having an investment like this, compound tax-free in the TFSA, is phenomenal. But then that has to be what they call self-directed. So you have to open up an account at Olympia Trust or Computershare or an entity, a trust company. There are some nominal fees associated with that. You open up your account at Olympia Trust or Computershare, and then really once the money's transferred from wherever you have it today into that account, you can literally just go and purchase AP shares directly, and that's what we do. That's my job. My job is to facilitate that, and yes, I do earn a commission. Let's be fully transparent. The cost of that commission, by the way, is amortized over the course of 5 years, and with your process and the cost. That's why part of the reason why you guys charge a 2.89% management fee. Would that be correct, Jess?
Yep, that's fair.
And one last question that we have here is liquidity. It's important we touch on this, that when you do make an investment into an entity like AP Capital, if you're making that investment, it's not fully liquid. You can't put your money in today and take it out tomorrow with no penalty. So if perhaps you can touch on very briefly what the penalty is on that.
Sure. If people can still see their screen, it's not a publicly traded company, so you can't put a sell order in and get your cash out the next moment. However, that also means that there's no dramatic volatility in the share price. As a previous screen just showed, our price per share has been $100 per share since inception. So if somebody wishes to redeem, there may be penalties because of the compensation that we pay to the firm that Peter works with. Those fees they run to zero after 4 years. So there's a redemption fee in year 1, year 2, year 3, year 4. So people should be thinking of this as a longer term investment or medium term investment. But if they do need their funds, we do redemptions on the 1st of every month. So if we have notice by the 15th, we return folks' money by the 1st of the following month. Now, in the terms of our offering memorandum, there are more restrictive terms, and this is to protect the holders in the event that there was a large number of people that wish to redeem and it was going to impact the fund in some measurable material way. So the terms of the offering memorandum say 60 days notice before year end, 120 days after year end. That allows us to, complete the audit, pay out 100% of the returns due to that person, and not impact, hundreds or 1,000 plus other holders. But in practice, for 10 years, we've been performing redemptions on the 1st of the month based on receiving somebody's signature on the 15th of the previous month. We do have some large investors, people that have put in north of a couple million. They know that it's our business to have their money out at work, and so they need to give us a bit more than 15 days notice. But you've put these, if I may interject, you've put things into the offering memorandum to prevent a run on the bank, so to speak, to protect yourselves. But on any given day, if it's reasonable, you get the money back in people's hands. There's just a deferred service charge. And one other point, sorry, Chess, I know we're running up on the clock here. I want to throw this in here. One of the questions was, well, how does your commission, does it come off the top? When AP Capital pays out a commission, if you put $100,000 into AP Capital, $100,000 is fully invested. That commission is paid out as an operating cost, so to speak. And again, that's why they charge a management fee. Chess, this has been fantastic. I think we covered a lot of things. We talked about the difference between lending personally, if you just lend to one individual, lending into a syndicate. Hopefully everybody understands the difference between lending in a syndicated mortgage versus lending in a MIC. And yes, you can get higher returns in syndicated mortgages or lending directly one individual to another versus a MIC. But for every extra percentage point you're getting in a return, there's a correlated risk associated. So I really encourage anybody doing research to analyze what risk are you willing to take for that extra 2 or 3%, because 9 times out of 10, it's not worth it, in my opinion. So I think this has been fantastic. We talked about some of the risks associated, some of the benefits of working with AP Capital. Not all MICs are created equal, so it's important if you are looking at investing in mortgages, investing in a MIC, to understand what makes AP Capital so, in my opinion, one of the best in the industry. So, Chess, I just want to say thank you very much. This has been fantastic, in spite of the
glitches we had on the technical problems getting this thing started. I'm glad we were able to figure that out. It looks like the PowerPoint went well after that. We flipped it over to your controls. Is there anything else that you'd like to add?
I think we covered a lot tonight, so I'm glad. Thank you for everybody that stayed on, and Peter, thanks for your time. I guess the last thing that we talked about earlier today is that if anybody is interested in having like a lunch and learn, we're located downtown. Peter can facilitate that. We'll provide sandwiches and answer more questions and go through more details if that's of interest to people. So just coordinate that through you, Peter.
And where's your offices downtown?
I'm looking out the window now. It's Burrard and Dunsmuir. So there's the 5 Bentalls. We're in Bentall 2. It is at 555 Burrard Street.
Fantastic. Well, listen, folks, if you are interested in doing a lunch and learn down at, and I'll pay for lunch, we're good, or Cheswell, you and I can discuss that offline. If you want to come down and have a lunch and learn, please send me an email. That's peter@peterkinch.com. Everybody on this call should have that email contact information. And if you're interested in learning more about AP Capital or you'd like to invest, just send me an email. We're going to be happy to answer all your questions. I want to wrap this up. We don't have time to answer everybody's questions. So again, Chess, thank you very much. That was very educational, and you know what? I think I'm looking forward to moving forward with you guys and some of the things you're going to be doing. These guys are looking to raise a lot of capital over the next while, and there's a big market to get that into. So, Chess, thank you very much for giving up a Tuesday evening here and sharing with us.
Thank you, Peter. I'm going to press close on this GoToWebinar, and that might mean I drop off the line. So thank you, everybody, and we'll speak soon.
Okay, fantastic. Have a great night, folks.